Hello and welcome to your Global Markets Technical Outlook for September 2015, brought to you by helixtrader.com. And yes, volatility is back in the stock markets, but the question everybody wants to know is, are we on the verge of a new bear market here, or is this just merely a correction in the ongoing uptrend? So that's the first question that we'll attempt to answer in this presentation. And then we'll go on to look at some of the other markets, such as currencies and commodities, and bring it all together to have some sort of holistic view of what the charts are telling us at the moment. So just before we get into it, a quick disclaimer that everything that you're about to see is just for your education and entertainment only. Nothing that you're about to see or hear is in any way a recommendation to buy or sell any financial instrument. Trading and investing in the financial markets is a risky business, and if you have any doubts about your own ability to make decisions, you should always consult the counsel of a licensed financial advisor. So let's get right into it, and first of all, of course, having a look at the US stock market. And on the monthly chart here with a very long-term picture, we can see we have had that amazing run since 2009, breaking out above those 2007 levels, and way up here, was in clear blue sky. It's just pulled back a little bit here, but on this time scale, there's no doubt that this market's still in a long-term uptrend, and the price could come all the way back. The price of the index could come all the way back to 1550. And still no technical damage would be done to that uptrend. So that's a long way to go for now. But from this picture, it's very hard to tell. Is this the start of something that could be bigger? I mean, if we look back at 2007, we start to see those big red candles which developed into 2008. Same again in 2000. The question is this what we're seeing here? Or are we seeing more of a correction like we saw here in 2010 and again in 2011? The price charts aren't really going to be able to tell us that, so we're going to have to look elsewhere. But for now, we're going to concentrate on the price, and then we'll move into more of the market internals to try and find out the answer to that perennial $64,000 question, I should say. This is a bit of fun. I had put Andrew's pitchfork indicator on a monthly chart here, and as you can see, once it tagged this high here, the low was then set, and as you can see, we never got a monthly close below that lower tine of the pitchfork. So again, this points to more of a bullish picture at the moment. As long as we don't get the market breaking down below this tine level at the moment, and for now it seems to be relatively safe, but obviously we don't know what's going to happen in the next couple of months. But if we can stay above that sort of 1965 to 2000 level over the next couple of months, then we should be out of the woods. But if we do get a breakdown below that sort of 1950 1920 level, then it could be game over for this market. So as long as we can keep closing within this pitchfork pattern, then the uptrend will be safe for now. Going down to the weekly chart, and this is the one that we've been showing this chart since for quite a couple of years now, and it does illustrate quite nicely this well-behaved uptrend that the market's been in since the bottom, since the lows back in 2009. You just scraped the top of that trend line, which was set back here in 2010. That gave us an indication that we were at the upper end of the range of where we'd expect prices to be. And then we did get that breakdown, but interestingly, the buyers showing up just where that lower trend line is, so right about that 1850 level, and that 1850 level is now clearly a make or break level for this market. But interesting to see demand showing up at that level with this long-term trend line that has been in play for quite a number of years now. And again, if that 1850 level can hold, then that's going to be positive for this market. But we do now have a make or break level to go on. On the Ichimoku, and as you can see, the very still a bullish picture. We have had a breakdown through the cloud here with the price, so that has given us a warning signal. The dark green line here is the lagging line, and so it's not until that and the price are both through the cloud that we would consider the market bearish. You can see here back in 2011 the price of the market falling through the cloud, but the lagging line never did. It recovered and pushed higher, so it remains to be seen what will happen this time. But 1880 is about the level that we want to watch for that lagging line coming through. So if the lagging line is still if it closes below that 1880 level in another month or so, that would be the time to start calling this market bearish. But for now, we're on alert. But as you've seen in the past, the market can recover from these levels. On the point and figure chart, well, again, this has also come back and is now testing this area of support, or diagonal support, if you want to call it that, around about that 1850 level. Again, it's really just a warning sign at the moment. We have that long column of O's there, just stopping out down at the 1850 level, and if we get a close below that level on this chart, that would be our first bearish double bottom breakout, as it's called in point and figure terminology, and that would be the time to call this market bearish. So while we are on alert at the moment, we haven't had that signal that's going to give us the break of the breakdown of the point and figure below that trend line. So watch and wait, but again, these markets can and do recover from these levels. So it's touch and go for this market at the moment, as you can see, and really looking at the price charts doesn't give us any real indication about whether this is the start of something bigger to the downside, or whether this is just part of the natural ebb and flow of the market. So the question we want to know is this a bear market, or are we just in a corrective phase in the uptrend? So we can look again. The price charts aren't really going to give us that information. What we're going to have to look at is some other indicators that give us a deeper understanding of the market. The first one I want to cover here is the price earnings ratio of the S&P 500, and here Robert Shiller has come up with what he calls the cyclically adjusted price earnings ratio, which takes the earnings are an aggregate of the last 10 years to avoid sort of the peaks and troughs that earnings can give. So the results are a little bit more correlated with the market highs and lows. And as you can see here, I've circled the 2000, the top of the internet bubble top, and then again 2007, the top of the financial crisis bust. And as you can see here, just on this on an absolute basis, where we are now, that sort of 24-25 level is getting up towards where we were in 2007. I think about 27 there on that chart. So by this measurement, it would look as though stocks are starting to get expensive, but what we're missing here is how the market got to where it is in this chart. And so what this chart here does is it uses this Hodrick-Prescott filter, which is kind of like a little bit like Keltner bands or Bollinger bands. It tries to sort of look at the trends that the market's taking within that. So, and in this case, the market being the price earning ratio. And now you can begin to see, if I mark some of the more major tops, 1929, 1987, 2000, 2007, they all happened when the PE ratio was well outside of its range to the upside. And those two major bottoms that we've had in the last decade or two, 2002, 2009, you can see the PE ratio well below its range. The range being the difference between the blue line and the green line, which are one standard deviation away from the center line. However, as you can see here, although the P ratio is high towards the end of the chart, it's actually still reasonably it's still well within the range of expectation. So it's still within one standard deviation of the center line of this trend that this Hodrick-Prescott filter is building. So in other words, we're not really at an extreme now, and so this indicates that we're probably not at a market top. We're certainly not a major market top at the moment, and this would point more towards what we're in right now being more of a corrective phase of the market rather than a topping phase. Exhibit B, if you like, is the so-called yield curve. And if you're not familiar with the yield curve, I'm going to give you a quick 2-minute demonstration of how the yield curve works. So on this chart on the left here, we have the what's called the yield curve. And the yield curve is really just the relationship between the interest rates of US Treasuries from very short-term expiries all the way out to long-term expiries. So here going from 3 months out to 30 months. The chart on the right here is the S&P 500, and the red line is showing the point in time where this snapshot on the left was taken. So during the start of the bull market back in 2003, what this shows us is that short-term interest rates were very low, long-term interest rates were higher. And so the absolute numbers on the chart are not as important as what the shape of this curve is. So the shape, as you can see, is from low on the left to high on the right. And what that indicates is that risk is low. In other words, bonds aren't paying very much money on a short-term basis. So that causes what's called a search for yield, whereby investments are drawn into the stock market, which carries more risk but offers more returns when risk is low. If we fast forward now to 2007, we'll see here that right at the top of 2007, the curve looks much different. So it's gone from more of a lower left to top right to more of a flattening, and it can even go inverted as well. So what we're seeing here is that short-term interest rates are now on a par with long-term interest rates, and what that means is that the much less risky bonds are now paying a decent return, and so that has the effect of drawing investment from the stock market into the bond market. In other words, why would you take the risk of holding stocks when you can earn quite good returns in bonds? And so you get that rotation out of stocks into bonds, and the stock market falls, the bond market rises. If we have a look at to the bottom of 2009 now, so of course after the financial crisis, the central bank lowers interest rates to try and regain confidence, and as the stock markets, what happened, the yield curve goes back to this familiar low risk shape where it's low on the left and high on the right. And once again, bonds now not paying very much interest, and so that pulls money out of bonds and into the stock market to take gains. Now, if we look at where the stock market's gone since 2009, it's made best part of 200% increase. So you may expect that the yield curve would be more of a flat shape as it was in 2007. But if we have a look at what it actually is, here's right at the end of the chart, it's now back to, it's still in that sort of low to high shape. So in other words, it's actually lower down than it was in 2003. So in other words, risk is still very low. And from an investor's point of view, why would I put my money into bonds which are earning next to nothing when I could be earning better returns in the stock market, albeit with a little bit more risk? So in other words, it's not until we see this yield curve flattening out, in other words, short-term interest rates rising towards towards the equivalent of long-term interest rates, that we'll see any meaningful rotation out of stocks and back into bonds. So again, this pointing much more to this being a correction in the market rather than a top. If this was a top, we would expect to see the yield curve up here and in that flattening shape. So risk is still very low, and this would seem to be, from an investor's point of view, more of a buying opportunity than a selling one. There's Exhibit C, if you like, there's a disconnect in what's going on with what's being sold down in this current correction. Here we're going to look through a few of what's called the aggressive sectors. So these are the ones that people would expect to invest in when risk is low and when expectations for future returns are good. This is consumer discretionary, so companies that people spend money on when times are good. And you can see, well, first of all, here, if you have a look at what happened in 2007, the price of this sector falling way before the actual market broke down. So market broke down somewhere in the middle of 2007 or towards the end of 2007 there. And as you can see, this sector had already been falling. So people piling out of the more aggressive sectors before the market dropped. Fast forward to today and look what's happening, the complete opposite. So as the market's going down, people are still going long aggressive stocks. So again, this points more towards people using this as an opportunity to get long for the next leg up. We'll flick through a couple more here. Technology, again, also considered more of an aggressive sector, much more risky stocks within that. And again, you can see this sector holding up well despite the sell-off that we've seen in the market. If we have a look, industrials are the only ones that have shown any sign of really breaking down. The financials, so this is the banks and the broking houses, and again, here back in 2007, you can see that they were selling off well before we got the actual drop in the market. And currently, we're not seeing any really sizable depreciation in that sector. So again, this points towards people staying fairly aggressive. And just to look at the S&P 500 by comparison, there's that circled area that we've been looking on the other charts. The S&P still rising as those aggressive sectors being sold down. People are becoming more defensive before finally we got the break. And yet here we've had the break and still those aggressive sectors are holding up. So once again, that's another tick in the box for this being more of a correction than a large bear market that we're about to dive into. So why did we actually have this this correction? Could we have detected it coming? Well, there's a couple of things we could have looked towards. I mean, this first one here is the Bollinger Bands. I mean, we had an amazing squeeze going on. The top here is the daily price of the S&P 500 or the SPY ETF as it is here, and the bottom here is the Bollinger Band width in percent, and you can see that most of the time that we've had a squeeze down at these levels, it's precipitated a decent sized sell-off. Now, here was the last one. Then back in October, if you remember, that was that large dive that we got, and then the quick recovery. But it was preceded by this the squeeze in the Bollinger Bands. Over the last few months, as we know, the market's been the volatility has been dropping and dropping. You can see that by this thing trending downwards, and then we're getting these extremes down here in the below 2% level. We got one finally here, and then bang, we got the expansion, and the market collapsed, and off it went. So that drying up of volatility was something that we could have looked towards. Although it's not a great timing tool, it certainly would have given us an indication of what was happening. Another one which was telling us that something was afoot here was the old market breadth indicator. We were seeing this deteriorate. So in other words, the market was becoming very thin at the top. The number of stocks that were supporting each successive higher high was getting less and less, and you can see dropping here from almost 90 down to about 75, and then we finally got the break. I think we got another higher high possibly there in July, and you can see this just dropping way down to almost 50. So that told us that there was a lack of confidence in the market, and that precipitated the collapse as we saw there. Interestingly, this is now down around 30 level, which is an extreme on the downside of this. And if we don't have the history here, but if we went back a little bit further, we would have seen that most of the time when this bullish percent turns up from below 30, certainly from below 25, it's generally a sign that the market has reached a bottom, some sort of capitulation point. So we'll have to wait and see whether that's the case in this on this occasion. I would suspect if this is a correction that we will get some sort of retest of the low, so we may see this go up and then down again before we're kind of completely out of the woods. But it certainly indicates that this market is very oversold, and lots of people have sold down stocks, probably oversold them to get us to the point where we are now. Another market breadth indicator we can look for is the percentage of stocks above their 200-day moving average, and this one looks across the whole of the NYSE. This does go back a bit further. This chart goes back to 2009. As you can see here, the position we're at now is close to where we were at the low of the 2011 correction and the low of the 2009 bottom of the bear market. So we're certainly getting towards that capitulation point if we're not actually there at the moment. And once again, this does indicate that we could be at certainly a short-term capitulation point. Although once again we could see that come back. We can see the price come back to test, but what we would be looking for with this chart, as you can see, maybe not be there that clear, but you can see by the numbers there that the actual bottom of 2009 was in March 2009, but you can see this had been rising, so it's only a small rise, but this had been going up. So in other words, people were buying even though the market was going lower. Once again, in 2011 we did get a retest of the initial low, and again this thing was rising. So this is what I would be looking towards for if we do get a retest of the lows, then we would look to see whether this was rising, and that would give us confidence that the next move would probably be higher. Looking to the sentiment now and the put-call ratio. Now this is another one which doesn't quite add up if this was the start of a bear market. If you remember from this ratio, when people are buying lots of puts, this ratio goes up. When people are buying lots of calls compared to puts, this ratio goes down. And generally at these extreme points we will get market tops and bottoms. Back here mid-2014 we did get an extreme bullish indicator that came just a month or two before we got that October sell-off last year. But interestingly, this time we didn't get anything. We didn't get that push down into that bullish extreme area. So we did back in 2011. So that was again telling us that that correction was on its way in mid-2011. But this time we didn't get it. So again, it points to this probably not being a bear market top. This is more likely to be a low volatility top, which is resulting in a correction. The other thing that's interesting from this chart though is that how everyone is piling into puts now. Clearly there's a lot of bearishness out there. A lot of people do think that this is the start of a bear market, so they're getting themselves positioned in puts and they're driving this measurement up towards this bearish extreme up the top here. And as you can see in the past, 2011 there was also a correction in 2012, and when we hit that bearish extreme, that was the time that the market rebounded. So this is definitely one to watch, and if we do get that bearish extreme, that could be the time when this market really does bottom out for the next little time anyway. On the VIX, this is a long-term chart, and I thought this was interesting that where the VIX got to this time, above 50, and the last time it had been there was really at the bottom of 2009. When the S&P 500 was at 666. Now clearly where we are now and where the S&P 500 was then is got no equivalence at all, but you can see there's a lot of fear around and a lot of people getting very, very worried and throwing the baby out with the bathwater almost to push this up to that top 50 level there. You can see those two large corrections that we had in 2010, 2011 also giving us prints up above that level, and the all-time high there of course was in the just after the Lehman's collapse, when people were just throwing everything out in terms of the stocks, and we were getting huge volatility swings in the market. So it looks like it would be hard to imagine that the VIX would shoot up any higher than it has done already. What's more likely to happen is what we've seen here in 2010, 2011, where we may even get a retest, but the VIX it makes a print that's lower than that initial high, and again that would tell us that we're on the way back up again. So, but we're not there yet. I mean, clearly we're still quite volatile. This number is currently 2780, which is still fairly high. It's up in this region here. So we still have to be a little bit cognizant that volatility is around, and the volatility might be here to stay for another month or two, and so we need to take that into account when we make our trading decisions. But my sense is that we've seen the worst of the volatility already, and that we will probably move back towards a volatility contraction rather than any more expansion. And again, I've shown this chart before, but this really does put the rally in context. Where we are here is this little red dot, or this dot that I've circled in red. And this chart compares all the other major stock market rallies since 1900. Along the bottom here is the duration of the rally, and then up the side here is the percentage increase. And you can see the average out round about where this white dot is here. And so we are in the current rally. This is the rally that started in 2009. we are we are low both in terms of duration and increase in price, and so once again this sort of gives us a bit more confidence that perhaps this isn't the ultimate top. We could be in for a bit more before we top out of this market yet. And just on the cycles here, we've got the Dow presidential cycle. We're in the pre-election year at the moment, so the idea behind this is that each of the 4 presidential years have a different signature, and if you sum all the price action up from all the various years, then you get something that gives some indication of a cycle. Clearly, it's not really been a good match for what we've had this year. I mean, we've been largely sideways since January. However, what did seem to me to be interesting was that this was pointing towards a top in early September. I mean, we got the top a little bit earlier than that in the market, but that if this does hold any water, then we could be in, as you can see from this cycle, a little bit more volatility through until sort of maybe October or even November time before we're back into that sort of Santa Claus rally phase. So I thought that was just of interest. Whether this holds any water. I mean, the cycles are only really ever indicative, but you never know, and certainly this looks like it might play out something like that over the next month or two anyway. So on the US stock market, we are still long-term bullish. It's as well worth bearing that in mind. Despite what we've seen, we are seeing a sell-off, of course. We're seeing volatility come back, and my sense is that we could be in volatility we could be in this sort of volatile period for certainly another month or two. We could look for another low, perhaps in October or even November, before we get the next move higher. We are, from what we can see, looking at all the intermarket analysis and the fundamentals that are out there, this does seem to be pointing to be more than a correction rather than a new bear market, and that's certainly the sense that I'm getting. Excuse me, and the probabilities in that case obviously favour a resumption of the uptrend once this corrective phase is done. So we just have to sit tight and wait for this to wind itself out. But as it comes to a conclusion, it could be a good opportunity to start looking for opportunities and bargains around in the market. For the S&P 500, we've got resistance still up there at that 2120 level, support now at that 1850 to 1880 level, and those quite key support levels now, we wouldn't want to see them broken and damaged too badly, as that might indicate something is bigger, something bigger is afoot. Looking now to the Australian stock market and the ASX 200 or the XJO. Here we can see this is actually given us a picture perfect piece of technical analysis. Here we had this lovely ascending triangle here. The market took a while to get up and then shot through that 5,000 level, headed up to 6,000, came back, right back and tagged, guess what, the uptrend line and the previous resistance, which is now support. So to me that's a picture perfect example of what we would have expected, the breakout and then the retest, and to me that's shown us that this market is still fairly bullish. We can see those long tails, mind you, this final candle not quite complete yet, but certainly we would want this market to maintain that 5,000 level. If there was any breakdown through there, that would be a concern, but it does look from this chart at least that the uptrend in the Aussie market remains intact. On the weekly basis, you can see we did fall through that 5100 level, albeit briefly. We only got 1 week that closed below, and then we've come back above it. So that could just be a temporary breach. We have got some more support down at 4600, but again, it would be a concern if it got way down there. Interestingly, this trend line here drawn from back in 2011, and the market came back and tagged it beautifully. So once again, this perhaps points to this just being a retest rather rather than any major breakdown of the market. It certainly doesn't look like too much technical damage has been done. I mean, this is a fairly corrective looking pullback here. Doesn't look like anything too impulsive at this stage, but we would want the market to start stabilizing now and move higher from here if possible. On the Ichimoku chart, this does look a little bit more bearish. We've had the price breakthrough here and we've got the lagging line both through now. However, if we look back to the last major correction in 2011, we did get much the same action. We got the price through and the lagging line through, and it was really, well, it did take a while to recover, probably, best part of a year, in fact. But it did regain that bullish the bullish side of the cloud and moved higher from there. So again, maybe just pointing towards us being in for some more corrective type of action. But certainly if you're just betting long and short on the Ichimoku, then at the moment this says bearish. On the point and figure chart, it's bullish overall. As you can see, the pattern is higher highs and higher lows, although we have had these two large red columns come back down, heading back down for that 5,000 level, which is going to be key support for this market. So we certainly wouldn't want to see that breached. We have had the point and figure sell in this market, so at the moment this market is certainly pointing towards bearish, and so we need to be cognizant of that. But certainly that 5,000 level looking pretty solid, and you would expect some sort of demand to show up at those levels. This is the bullish percent index for the ASX 200, so the price up the top here on a weekly basis, and then the bullish percent index on the bottom here. Just thought it was interesting that every time we did get a bullish percent print below around about 20, in other words, when less than 20% of the stocks in the market were bullish, beg your pardon, that was often a time of a reversal in the market. So you can see these green arrows pointing to the lows in the market, indicated by these things. We did get a false signal just recently. Well, false, I mean, we did get a little bit of a bounce there, but it wasn't really any of the sustained uptrends that we have had in the past. But, you know, any indicator that gives you 7 out of 8 winners is certainly got to be one that's taken heed of. And certainly we have had that print below 20 there, the turn up. So perhaps we are on the march once again for this market. But again, we just have to be a little bit careful, because the Aussie market does love coming back and retesting. Here's a low here, retested here. There's another one here, retested here. There's another one here, retested quite quickly that time. There, retested there, retested there. So we've had the low there. The jury's out about whether this green candle here is the retest. I think we're going to go up and down for another retest, maybe in another 4 to 6 weeks, or possibly longer. And then once we get that retest at 5,000, that will probably be the time when this market will reverse higher. But for now, it looks like we've stabilized at that 5,000 level at least. So the Aussie market, we have to give it the benefit of the doubt. It's innocent until proven guilty, and it does seem that it is long-term bullish on the long-term charts. We're seeing some short-term weakness. There's a lot of bearish sentiment around at the moment, but for now that 5,000 level is holding. Resistance still looks a little bit far off at 6,000. We're probably going to take a while to get back there. But as long as we can hold that 5,000 level, and we may get a retest, as I've mentioned, then I think we can be confident that this market is going to surprise us to the upside rather than the downside. Switching now to the currencies, kicking off with the local currency now, and the Aussie dollar here. Just interestingly, we take this trend line back to 2001, and it has just sort of breached that there, but just finding a little bit of support at that 70 level, which has proved to be both support and resistance in the past. So maybe just the early signs that this currency just trying to stabilize. It has been slammed. There's no question about it. It's cut 2 big impulsive moves to the downside. So, it's definitely bearish, but, perhaps maybe a bounce. We may get a bounce back up to 80 before any other damage is done. But for now, it's a bit early to say, but it does look like we may have found some support there at that 70-cent level. On the euro, well, this $1.20 level here has been quite key for the euro, as you can see, throughout its history, really. And we did get that convincing breakthrough as it slammed through there back in 2014. But my sense is that we'll get a little bit, we'll get a retest, as we've seen, the Aussie doing from the top side. I beg your pardon, the ASX market from the top side. But yeah, my sense is that this will get a bounce up here to tag and retest this 120 as resistance, and then we'll probably get another leg lower. I mean, there's no question that the market is damaged. It's definitely bearish now. So if we can get some short-term recovery, that might precipitate another leg lower. So that $1.20 level is a key level for this market. On the pound, well, this is kind of just stuck in this sideways consolidation level at the moment. It has been really since the 2009 lows. Between that sort of $1.45, $1.70 level, it's just bouncing around in there, and there's really nothing to report about whether until this can get some traction one way or another. You'd have to say of all the currencies, this is probably holding up the better of most of them, considering what the US dollar is doing, as we'll see in a second. On the yen, well, still nothing to write home about here. It's other than it may be finding some stabilizing forces there at that 80 level. It's is nothing. You certainly wouldn't want it to take a long-term long position in this just yet. You would certainly want it to stabilize, and that could take months or even years for it to do. We may even get it go through and test the 74 level down here. That certainly wouldn't be a surprise. But for now, just taking a breather there at 80, and who knows, we might get a bounce back up into this area. It is deeply oversold at the moment, so be surprised if there's anybody else left to sell just at the moment, and that might just give it a little bit of relief for now. On the US dollar, well, this is the one that's bullish, which is driving everything else lower. We have had that huge run out of the symmetrical triangle. I mean, this is picture perfect technical analysis. The squeeze, the drop in volatility, and then slam, the massive move to the upside. We're now above that 92.40 level, and we could the next stop that I'm seeing is that 102.70 level, so that would be the next stop for this market. It's unlikely that it's going to break back down through 92.40. Certainly if it came back down to near that level, that would be a buying opportunity, I think. But certainly it's looking very bullish for the US dollar at the moment, and certainly we hear that rates are on the or could be on the increase over in the States, and that would certainly be bullish for the US dollar, you would expect. On the commodities and the Goldman Sachs Commodities Index first up, and you can see, well, we know the story of this. This is just getting sold down hard at the moment. People thought it was stabilizing around about that 400 level, but then it's had another leg lower. Interestingly, it's just stopped at this long-term trend line, which actually goes back all the way to 1999. So just finding support there for the moment. We've got that solid support there at 303, which is the old financial crisis lows. So it could get down there. That would break that trend line, obviously. But if it can get back above 400, then that would see signs of it perhaps trying to stabilize before any move anywhere else. But clearly a lot of damage done, and we would expect. I mean, this is volatile. It goes down and up quite without thinking almost. So there would be no surprise whether if it just leapt back up there, but we might be in for some more consolidation, such as we got back here in the sort of the mid to late 2000s. We'll just have to wait and see on that, but certainly bearish at the moment for the commodities as a group. Oil also looking very bearish, as you know. This is getting quite heavily sold off. This has actually just sort of kind of broken through its little trend line here that's come back from the late 90s. So But it has found some stability around about that 37.50 level, which has proved important in the past. So perhaps just buyers cognizant of that fact and just coming in to support the market. But clearly, it did have this relief rally here, but then it got slammed again and is now looking quite bearish. It wouldn't really be worth looking at oil, I don't think, until it can get back above that sort of $75 area. Until then, it's going to be stuck within this region here. And finishing up on gold, of course, we've got nothing to write home about here either, I'm afraid. All we can really say, I guess, is that the speed of the downtrend is slowing a little bit, and we're not seeing it as impulsive as it was. However, it has now broken that 1150 level, which it did look like it was going to hold, and it's been unable to regain that at this point. So we would really want to see it back above that. If not, who knows where this could go. There's certainly nothing in the way of any major support below it until we get back to the 2008 lows. So that still remains a possibility for this market. 1350 is the downtrend line, so you would want to see this above that 1350 area before you would be interested in any longs, is my sense. But for now, the gold has just been a great short, no question, ever since sort of 2011, 2012. If you'd managed to get short, then you would be sitting pretty, no doubt. And just wanted to throw this chart in here. I don't want to get all Alan Kohler on you, but this is a chart showing the current slowdown in trade, if you like, from China. And this is, I guess, is why we're seeing a lot of negativity, especially in those commodity markets, both the energies and the raw materials. China is clearly not buying as much as it did, and this is really going to be a factor that's going to create a bit of a headwind for Australia, because we depend largely on our exports to China. 30% of the economy based on that. So that's going to hurt a little bit, but just in general around the globe, we're going to see that the Chinese impact is going to affect markets. So certainly on the commodity markets, things are probably going to remain a little bit more muted for the foreseeable future. So just summarizing that all now, and as we know, global markets are volatile, and if you love volatility, you should be grateful that volatility is back, because it has been a very boring market for the last 6 months or so. But that looks like that volatility is going to be around for a little while yet. However, we haven't seen any major technical damage done to any of the markets that we've looked at so far. So I don't think that we are in a top of a bear market type of phase. I think we're more in a sort of corrective phase, and that's certainly what the market internals and the fundamental indicators are pointing to. So I think we just have to sit tight and wait and see what happens in the next couple of months. But what we should see is some sort of a contraction of the volatility before the next move higher. Most major currencies, of course, are very weak or consolidating, and that's primarily due to the strength in the US dollar. That US dollar is going up because of fundamental economic factors in the States primarily, but that's driving most of our other currencies lower, which certainly isn't doesn't have all downsides. Certainly, for exporters, that is definitely a good thing. And as we've seen commodities remaining weak across the board, we've got the China factor, we've got a number of factors in that space, but we are seeing that some of them, especially the energy ones and so on, just starting to possibly stabilize at those low levels, and so will remain to be seen if that's the start of some bottoming pattern, or whether this is just a breather in the downtrend. But certainly remaining weak for now. And just a reminder, if you're looking to improve your own trading and take your trading to the next level, then you're interested in looking at some coaching, or looking at using more of a quantitative approach, having a look at some quantitative systems, or you're interested in developing your own trading systems, then please get in touch. I'd be delighted to have a chat with you and see if there's anything that we can do to work together. If you have any questions about this presentation, feel free to drop me a line there at alan@helixtrader.com. And I will just say that my website has been redesigned and relaunched now, as you may have seen if you've been there lately. So I'd appreciate you to go along, have a look, give me some feedback, and we will be looking at adding a lot more features, a lot more frequent posts in the blog and so on now. So feel free to have a look there. There's also some model portfolios that I'm looking at launching as well. So feel free to have a poke around. I love your feedback, and if you have any questions, of course, please give us a shout. And in the meantime, I wish you good trading, good luck, and goodbye.